Hi, and welcome to my monthly Market Insights video. My name is Dan Timitich. I'm a managing principal and one of the portfolio managers at T2 Asset Management. This video is going to take a look at what happened in May and give you some of my thoughts going forward. If you have any specific questions or simply want a second opinion, please call or send me an email and I'll be sure to follow up with you. Before we get started, a quick reminder, this video is for educational purposes only. Opinions expressed in this video are mine and do not reflect the opinions of other portfolio managers at T2 Asset Management. You should always consult with a financial advisor before making any investment decisions. Investments involve risk and are not guaranteed. Okay, let's get started. While much of the media likes to focus on what's happening in the stock market, I want to focus on the bond market this month. Most investors don't realize how important the bond market is and how large it really is. The U.S. alone has about $41 trillion in outstanding bonds, and it's estimated that there's about $100 trillion globally. In comparison, the U.S. stock market is about $30 trillion. So if investors want to really know what's going on, they really have to pay attention to the bond market. If you've watched my previous videos or read some of my commentary, you'll know that we've been in a falling interest rate environment for the last 30 years, and we're at an inflection point where rates are more likely to increase. Since hitting their low in 2016, the 10-year Treasury yield has steadily risen and has nearly doubled since then. Just in 2018, the yield itself has increased about 0.5%, and it's crossed over 3% for a couple weeks. Why is this important? Well, many investors hold bonds in their portfolio to dampen the volatility of the stock market. But as you can see by this chart, the aggregate bond index has lost money this year. Now, the bond market did rally in the second half of May, but it still remains in negative territory for the year. As this next chart shows, not all of the bonds have been performing the same way, and it's important that you know what you own. I've talked about my preference in the past to hold credit risk over interest rate risk, and this has definitely helped us this year. The top two lines on this chart here show the performance of SRLN and PGHY. Both of these positions did better than the aggregate bond index represented by the purple line, and much better than the long-term Treasury ETF SPTL, the yellow line. SRLN and PGHY are both high-yield, short-duration bond ETFs that I've owned throughout the year. The takeaway here is to make sure that you know where your risk is in the bond market. Going forward, I think investors are going to need to be more active in their bond allocation than they have been in the past. The interest rate environment is changing, and you're going to need to adapt. If you haven't read any of my previous articles on bonds, you may want to. You can find one specific article that I published on my website. It's called How Rising Interest Rates and Inflation Affect Bonds. Now, shifting to the stock market, May was a good month across the board. The real standout here is how well small caps have performed for the month. The Russell 2000 index is up 6% and is outperforming large caps for the year. Turning to the sectors, technology led the way in May and is up nearly 10% for the year. The tech and small caps are doing quite well, and it's clear that investors are comfortable adding risk to their portfolio. I know I'm very pleased with my overweights in small caps and tech and continue to maintain an overweight there. If you're familiar with my videos, you know that I look for specific components to make investment decisions for my clients. So looking at the economy, earnings, valuations, markets, all of that gives me a comprehensive view of the current environment and allows me to make better investment decisions. So let's take a look at what our chart looks like today. The economy continues at a remarkable pace, even with the first quarter GDP coming in at 2.2%. The current Atlanta Fed estimates growth of the GDP for the second quarter is at 4.8%. Private sector growth strengthened in May, and jobs report indicated continued growth as well as wage increases. With unemployment dropping, leading economic indicators expanding, and reported numbers all pointing to a very good economy, I have to be very positive on the economy. Looking at earnings, it's hard to say anything except wow. After an unbelievable first quarter earnings season, analysts are upping their estimates and looking for earnings to grow around 19% in the second quarter. With 3/4 of companies reporting a positive EPS surprise, you have to be positive on earnings. Moving on to valuations. Not much has changed from last month. The forward PE ratio is at its 5-year average, and as I mentioned last month, these valuations are justified as long as earnings come in as expected, and they have. Corporate bond spreads remain on the tighter side, and the 10-year Treasury did cross above the 3%. It fell back below 3% a couple of weeks later, but I still want to see it stabilize before changing my opinion on valuations from neutral. Finally, the markets look good. Even with the talk about trade wars, North Korea, Russia, and whatever else, volatility has come down in May, and stocks are comfortably above their February lows. The yield curve is relatively flat, but I think it's too early to panic, so I'm generally positive on the markets. So the things I have not that I like have not really changed from last month. I still like stocks over bonds. I still have an overweight to small caps, mid caps, technology. In bonds, I still like high yield and floating rate bonds, as I mentioned at the beginning of this video. Things I don't like include long duration bonds, government securities, utilities, and REITs. Last month I included consumer staples on this list, but I took it off as I added a small position in the middle of May. Staples have been hammered this year, and I think there's a shorter term opportunity in the sector from a seasonality and a mean reversion perspective. I hope you enjoyed this video and found it helpful. And remember, you don't need to do this alone. Whether you're looking for an advisor or simply want a second opinion, please reach out. Thanks for watching, and we'll see you next month.